And welcome back. So this week we're going to talk about quite a specific part of the process, which is the art of the valuation, and it's how to value a business in the world of M&A. So it's something that I think, Paul, you would probably say you've learned the hard way. It's great now that there are teams of people around you with that expertise that can do it much easier than maybe you and I could do. I think there's people in our team that can analyze balance sheets and stuff in 5 minutes, where me personally, it'll take me probably a week to do the same sort of thing. So firstly, I suppose let's just talk about why the accurate valuing of a company is so important when you're in the world of mergers and acquisitions.
So I think just to sort of take it back a step before I answer that question, I think, ultimately, a company is worth what a willing buyer is prepared to buy for and what a willing seller is prepared to sell for, and whether or not those two things are aligned. And I guess, the reason why most deals don't happen or fall through or don't get to a point of being agreed is probably because there is a misalignment between what a seller wants and what a buyer is prepared to pay, and that's basically why the deal doesn't progress. So I think when we are looking at the valuation of a company, it's really important to do it accurately. And for me, there's obviously many different ways that you can value a company. There's different metrics, but principally in most industries, and it's not every single industry, but most industries, companies that change hands tend to do so for a multiple of their profits. So you apply a multiple to the profits. Typically we tend to look at EBITDA, earnings before interest, tax, depreciation, amortization, as effectively the free cash flow within the business, and we apply a multiple to that, and that values the goodwill, and then that's sort of what we use as a very basic way to value a company. But if you're there's many different ways to do a deal, and it doesn't necessarily always mean about you have to give them cash or money. You could offer them an earn out, a deferred note. You could merge them with another company you own. There's many different creative ways to create a deal, but each one of those components of what I call the deal pie is worth something. It has a value, so ultimately it gets to a certain value. Now, if you're taking on debt, maybe as part of the deal, or you're offering some sort of seller financing where you're paying them over a period of time, then it's really important that obviously whatever that valuation is, not just is fair and reasonable and meets everybody's expectations, but is also affordable. If you pay 10 times multiple of profit versus if you pay 2 times, it's either going to take you a lot longer to pay that sum from the future cash flows, in the higher model. So you want something that's affordable and reasonable and can be presented as a fair deal. And it also ensures that you're not overpaying for a deal, and that it's financially sound. And ultimately, why are we doing this? Well, we want to buy a company, build it, sell it, and make a return on that. And thus, that the more you pay, the lower or the longer it's going to take for that return to kick in. So yeah, I guess that would be why valuing a company is correctly is very, very important.
So what are some of the main valuation techniques that are used in M&A?
Well, I've already given you one. As I say, a multiple of profit is traditionally the one that is used most of the time in the transactions that we do. But you can do a balance sheet assessment, so you can look at what assets and liabilities you're going to acquire, and obviously attribute values to that. If you're doing an asset purchase, you could look at purely the whatever assets you're going to acquire as part of the transaction. What are they really worth? For example, a trucking company is going to have a load of trucks, but they've probably driven to the moon and back and have depreciated heavy, and you're going to have some potential capital expenditure items. So you would attribute a value based on all of that consideration. Another common one is sort of discounted cash flow. So you calculate the present value of projected future cash flows as a way to value a company. You can look at precedent transactions, so you can look at what have other companies in this space sold for. Are there any sources of information? I mean, for the joint venture partners that we work with, we do have access to some significant data sources where we can literally look at pretty much most industries and see what's the typical average multiple in the last 2, 3, 4 years. What have those companies sold for? And we can use that then as a benchmark in terms of where we might sit. So I guess, as I say, many different ways, but the common one is certainly to look at a multiple of profits. If you're interested in mergers and acquisitions, we have a free to join community of deal makers around the world where we share knowledge, expertise, deals, and joint ventures. I produce regular content there, and it's the first place that you can see it. So if you'd like to find out more about this and how we can joint venture together, I guess the vast majority of deals that we have done have been with joint venture partners. And I guess to get to 100 plus deals, there's only so many hours in the day. So by sharing the work with like-minded others, we can increase that bandwidth. So to learn more about this and to join our community, visit buybuildsellprogram.com.
Okay. So can you walk us through how you would decide which valuation method is going to be suitable based on the type of acquisition that's sat in front of you?
Yes, so effectively it will be driven by the sector itself. So, if it's a particularly acquisitive sector, we'll be looking at comparative transactions, and then we'll use that as possibly our method. So, for example, in the real estate industry at the moment, there are several big operators in the UK that are private equity backed that buy up these rental agencies. So if you think you're a private landlord, you pay an agent to find you tenants and manage the property. And I guess the reason why they're quite attractive is if you've got 100 or 200 or 1,000 of these landlords each paying you, 150 or 200 pounds a month for your management service, then you have this volume recurring revenue, which can become very, very attractive. So there's a number of PE operators that are acquiring in that space. So very, very acquisitive, very, very competitive. And typically they don't apply a multiple of profit. They apply a multiple to that recurring revenue. Usually it's around about 2 times. Whereas you can go and look at, say, like the transportation industry. So let's say you're a trucking company, you transport goods for customers. That is a model where maybe we would be more looking at the underlying profitability and cash flow of the business. So if we used EBITDA as a measure, for example, in a trucking company, the challenge with a trucking company is that, probably the life of these vehicles are about 5 years. And during that time, they do lots and lots of mileage and obviously depreciate significantly in value. But that depreciation, whilst you can offset that against your tax liabilities in certain jurisdictions, effectively whatever you're charging to your P&L to reduce your profits in depreciation, you're probably spending out in capital expenditure to basically buy new trucks as the old ones come to the end of their life. So what you could find there is actually it makes sense to maybe base the deal on EBIT rather than EBITDA, so that you're sort of discounting almost the depreciation element, and you're factoring in the potential capital expenditure requirements of the business. So as I say, every industry is different, but we base it on the research, we base it on what other acquirers are doing. And yeah, we're typically looking at the sort of available cash flow in most cases.
When you are looking at a company, then what are the sort of initial indicators that you would probably look towards to get a sense of its value?
Yeah, I mean, I guess first impressions are we'll look at a statutory set of accounts. So we're looking at revenue, we're looking at EBITDA, we're looking at free cash flow. We're then probably then going to couple that with qualitative factors. So, their market position, their brand strength, their customer loyalty. Are there any sort of high risk areas? So, for example, if they have most of their business with one customer, then that would be far more risky than a very diverse customer base. And again, we're looking then at the red flags. So any fluctuating cash flow, high debt, margin erosion, revenue erosion, all of those sorts of things. That they're probably the main things that we're going to look at when we first start looking at a deal. There's a lot more to it than that, and obviously a lot more work and analysis that goes into it. But I guess as a very high level view, let's have a look at what's the revenue, what's the profits, what's the cash flow, how does it position itself in the market? Are there any major red flags in those financial statements? And then that gives us a good base point to start from.
I mean, is there a specific metric there that you pay more attention to than others?
I wouldn't say a specific metric. I mean, we have a minimum deal size in terms of what we do from an EBITDA point of view. The principal reason for that is if we're borrowing money to do the deal, there's a lot of work and effort that goes into that. So we might as well make it worth our while. So the more profit, the more cash there is, the more worthwhile it becomes for us all. But we're really looking for consistency, to be honest. We want to buy long established, well-run, profitable companies that, year in, year out have been consistently making similar profits. Maybe they've been growing slightly. And that's what we're looking for. What we're trying to probably stay away from is those where there's too much fluctuation. Maybe one year they've had a good year, the next year it's not. Maybe costs have gone up, maybe margins are starting to erode. Those are things that wouldn't necessarily put us off the deal, but certainly would, when you're looking at valuation, would probably be factored into more of a lower valuation than something that didn't have those things.
Does the sort of market position of a company affect its valuation?
Um, it depends on the industry. I mean, again, if you go back to the real estate industry, there's, real estate companies that specialize in the higher end property market. There's agents that specialize in commercial, where maybe there's more money to be made. There's others that, have cross-selling, so they might sell financial services products, for example. So it really depends on, each industry and, what the nuances are with that. I guess that's not as much of a concern in terms of the brand itself, but what we are looking for is that they have a reasonable reputation. So you go Google a company and look at what the customer reviews are like on that particular company, and if there's a load of negative stuff out there, or you can go on to like employee survey websites and see what people say about working there, and if it's a load of negative stuff, again, wouldn't necessarily put us off the deal, but means that that says to me that possibly there's a lot of work to be done around improving the customer experience or the employee experience. So recruiting and retaining staff could be more difficult. Getting better margins out of customers with a poor reputation, cross-selling to customers if you're not really delivering for them already, is going to make it much more challenging. So I guess that wouldn't be as valuable as a company that had all of those things really, really well done.
I think there is a misconception out there that a lot of people buying companies use the due diligence process as a way to basically discount the price. So you've agreed a valuation for the company, and then you're going through due diligence, and you do hear horror stories about how, whether it's companies or individuals, then start to chip away at the price to get it a little bit lower. That's not the case for how you do things. But what role do you think due diligence really does play in refining a company's valuation?
Yeah, so I mean, it is quite common that most buyers will use the due diligence process to chip the price. They're going to go and look under the bonnet of the business. They're going to go and find a load of problems, and they're going to use that to justify why they should pay a lower price. That's not our position. That's not what we do. We use due diligence twofold, really. One is to, yes, flush out any risks and issues that could be a concern, but that's more to ratify whether we want to do the deal or not. Not necessarily using that then to renegotiate the price. And then secondly, it's about getting heads up on the business itself and learning the business before we own it. So, if we're really deep diving into all of the processes and systems and documents, we're getting a good feel for how the business works, how it operates. And that means that we can go in with our eyes open. So when we actually turn up on the day of the deal, we've got a much stronger chance of integrating that company and transitioning ownership in a more efficient way than if we hadn't done that level of work. So yeah, due diligence is really, from our perspective, that's why we do it, and what's important about it. We don't use it to justify the valuation, but it's certainly not uncommon for others to adopt that position.
So putting all of that into sort of context in sort of more of an example form, is there a real life example that you could use of I don't know, a deal that you've analysed, how you actually went about it, how you valued it, the conclusions that you reached with it?
Yeah, so one of the deals that we did recently was in the marketing industry, so a market research company, and this was a long-established company, pretty consistent profits. It's a service-based B2B business, so the only real assets it had was its receivables, its cash. Didn't own the premises. Obviously, it's not an industrial business, so didn't have a factory for manufacturing, anything like that. It was purely a service-based business providing marketing research services to other companies. So really what we're looking at here is the underlying profitability of the business. This particular company was quite a small deal. It was making around about 300 grand worth of profit. So quite small in the grand scheme of things. And the typical multiple for companies in that particular industry is 2.2 times. So we did 2.2 times the 300 grand of EBITDA, which gave us just over 600 grand for the goodwill. And then we look at the balance sheet. So what hard assets do we acquire on closing? And in this particular case, it was really just the receivables and the cash, which is really working capital. And then there was a little bit of small debt. I think there was an overdraft or a bank loan in there. So the net assets of the company in this particular case was around about 500 grand. And normally we would add that on, adjusting for working capital. So in that particular example, I think we paid 1.1 for that particular acquisition, and that's how we analysed it. Sometimes you can look at other deals where maybe the owner might own the real estate and they might want to carve that out and keep it as a passive income. So we'd obviously adjust the balance sheet accordingly. If there was any intercompany positions or external loans that were going to be settled as part of the transaction, again, we would look at how that would impact on the on the actual balance sheet.
Are there any sort of external factors that people need to think about? So I think given that we've just gone through the last few years of some things that no one could see coming, so the COVID pandemic, I think there's wars going on that are impacting the economy, but things like economic conditions, do they impact a business's valuation?
Yeah, so I think we've seen recently in the UK, for example, there's been a change of government. There's been a different approach to tax. So the social security element of tax for businesses, businesses pay a percentage of the workers' wages in social security costs. So previously that was 13.8% of their salary over and above a certain threshold, and that's now been increased to 15%. So 13.8 to 15% is quite a significant increase. And we did an analysis actually on a deal last week where we wanted to see what the impact of that was. And on this business that makes around about 250 grand a year in profit, this additional cost was going to be about 22k to the business. So effectively almost 10% of its profits was going to go in an increase in tax. So sometimes there are government changes, tax changes. There could be the more macroeconomic climate. So boom and bust cycle. Are we at the peak of a market, or are we at the trough? Are we in a recession? What about regulation? What about inflation? What about interest rates? What about the industry itself? They're all very important factors that we bring into play in valuations. And of course, there are some things that are unforeseen. I don't think anybody saw the COVID pandemic coming, and the way that that was managed in terms of sort of lockdowns and not being able to trade, and the government pumping in quite a lot of debt into supporting businesses through that challenging time. So obviously there are certain things outside of our control that we don't foresee, but we try and plan for most scenarios, and we're looking at all of those things when we're trying to come up with a valuation that we feel is fair but also affordable, and structured in the right way that's not going to put the business under any undue strain.
Do you often find that the motivations of both buyers and sellers can actually affect that final valuation and that final sale price? I mean, you sort of mentioned earlier that a business is worth what somebody's willing to pay for it and what somebody's willing to sell it at.
Yeah, I mean, I think it depends. So a seller's urgency versus a buyer's long-term interest, I guess, is a good one to look at to start with. I think if the seller just would like to retire because they're getting to a certain age, but whether they retire now or whether they wait 3 years, they're not really too bothered, is going to be not as motivated and might hang out for a higher price than a seller that possibly has some health issues, and there's a real pressing need for them to retire to address those health issues, so they might be more willing to compromise on price. So that's not trying to suggest that we're going to be opportunistic, but that could potentially, a seller might be willing to compromise more on the valuation than in that scenario than somebody that's just started out a process that isn't as motivated, perhaps. I think as well, if you're a strategic buyer, you're probably you would be able to justify why you might pay more for synergies, because if you bought that competitor or that tactical acquisition, you could see immediately a cross-selling opportunity or a consolidation that was going to ultimately drive the profits of both businesses up quite quickly. So you being able to get a quick return on that, you might be prepared to pay a little bit more than somebody that doesn't have a business in that space, where those synergies could be unlocked.
Okay. Is there a way of accounting for the potential growth of a business? So I think businesses that are setting themselves up for selling ultimately try to maybe enhance the way that they might look, which you can understand why they would do that, but how you possibly spot that. And also there is going to be companies that are legitimately growing, and how you really plan for that in your valuation model.
Yes, so look, I mean, if you're going to approach selling your business properly and sensibly, probably up until this point, you've always paid your accountant to reduce your profits as much as possible, because that will potentially mean that the tax you pay is reduced. But obviously, if companies are selling for a multiple of profits in most cases, you want that profit figure to be maximized. So, any clever creative accountant can make a profit better or worse. Instead of charging things to the P&L, you could capitalize things on the balance sheet, which effectively will increase the profits. So what we're looking for when we're diving into the detail is the consistency of the business. How much profits has it declared and made over the last, say, 3 or 5 years? And then if all of a sudden it's suddenly gone up, why is that? Is it because some clever accountants come on board and made the profits look better than the reality of what they would have declared previously? Or has something fundamental changed in the business? Have they landed a new contract? Have they been able to reduce their costs, which has made them more profitable? So it's not just understanding the what is going on here, it's the why. What's created that? Why has it happened? Is that consistent? So that we can determine what that future cash flow is. And you can use an earn out structure. So generally what we tend to do is we look at an average of the last 3 years, and that 3 year period tends to be quite consistent. But if you've had a fluctuation and they say, well, do you know what, next year we're going to win another contract and that's going to mean that we're going to double our profits, well, you might say, well, if you're going to stick around and help us with that and achieve that, then we might pay you a percentage of that over and above whatever we're agreeing as a sort of base point valuation. So it means win-win. They're getting more out of the deal for landing that contract, and you're getting more out of the deal because you're getting a business that ultimately is going to become more profitable.
So I appreciate that over the last sort of 15 years or so, that your methods have been quite comprehensive for how you would determine the valuation of a business and what you're prepared to pay and when you would potentially walk away from something. And having built teams of experts around you to help in that must be very different to, you obviously are in a privileged situation that a lot of people want to joint venture with you. Those that want to joint venture with you and they find deals, I'm sure you hear it all the time, that this is the best deal since sliced bread and you've got to make it work.
Yep.
What's your opinion on how they're valuing versus your methods that probably are a bit more comprehensive?
Yeah, so look, I mean, every seller, well, regardless of what you offer them, it always asks for more money, both as an overall valuation and what they might be getting at closing, because that's just how it is. 99.9% of the time, you can never offer what they want. So it's then about trying to negotiate and finding realism and seeing whether or not you can make all of those things work. So it's very easy, particularly when you're starting out in this, that, doing a deal, overpaying for a business just to get that first deal over the line is not uncommon. But we've built a process that works, that sets expectations with people when we're going on this journey, so that they fully understand why we value companies the way that we do, why we do deals the way that we do. And then it's really trying to find compromise in those things when it doesn't quite work for the seller, and tweaking things so that we can actually get to a point where we can agree something.
I mean, is there any sort of closing advice that you would give to people out there that are in the world of M&A, getting into the world of M&A, that they should really think about that? Yes, not every deal is the best deal that you're ever going to find, and there is a point where you should walk away from it. But also, I think a lot of people that are new to this might not have made the mistakes of what happens when you overpay for a business, and how that can impact the business, the cash flow, the future longevity of it.
Yeah, so I think there's lots of content out there these days where you can, look at things that can help in terms of valuations. You can read books. You don't need to be an accountant, but you can go and consume videos on YouTube about balance sheets and profit and loss, and valuing companies and the discounted cash flow model. So I guess I'd consume knowledge, not in any great degree, but having a good base understanding, and then networking with other deal makers. So we have our own community at Buy Build Sell, where you can join for free, and you can share the journey with other like-minded deal makers and entrepreneurs, and you can ask them for help and advice. So, if you're valuing your first company, you could share that valuation and you can chat to people about it and ask for their input and feedback, which can be quite useful. So yeah, for sure, I would just recommend getting the knowledge and talking to people, and maybe partnering with people that have been there, done it many times before, that can obviously help spot the overvaluations and the overpaying potentials that could cause a problem later down the line.
Okay, well, I think we'll wrap it up there. But as always, great talking to you.
Great. Thanks, Ben. Can I ask you a favor? If you like this content, then please do subscribe to the channel to receive more content like this as we upload it. It helps our channel and shares the message with like-minded deal makers. It also helps me to connect with our audience and bring you more content that you can watch.